You can pick winning stocks. There isn't some hereditary knack or gene that exists for becoming a great investor. Although many would like to blame their losses on some inbred tragic flaw, believing somehow that some people are just born to invest and others are not, this thought process is bullshit. There are literally thousands of stocks that trade publicly every day. Many of these stocks will be complete duds. But on the contrary, opportunity exists because many of these stocks will also go on to be significant winners. With every stock you purchase, there is a chance that you could be buying a big stock market winner, or as Peter Lynch likes to call them, multi-baggers. A stock that could double, triple, or sometimes even return 10 times your initial investment. The classic 10-bagger. Now, how do you get your hands on these type of stocks? Well, you could take a random stranger's advice on social media, or pay thousands of dollars for a day trading website that's guaranteed to give you a 100% return. Or there's a different method that I might suggest. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, and he averaged a 29% annual rate of return for that time frame. This made the Magellan Fund the top performing mutual fund in the world. Lynch, who knows a thing or two about money management, argued that a majority of the institutions and funds on Wall Street are simply managed to achieve a market return, an average return. The reasoning for this is because many of these funds are managed by people who want to keep their jobs, investing in safer stocks, taking on less risk, because it's a better recipe for keeping your job than explaining to your boss why you purchased some small cap stock that lost 50% of its value. If you look among the large institutional funds on Wall Street, you'll notice that many of their major holdings are similar, and their performances are also similar. Lynch claims that if you invest like an institution, you are doomed to perform like one. And for most people, achieving a market return might be the best recipe for success. However, the individual investor is not forced to own hundreds of different positions like many funds are. Rather, they can choose to own 5 to 10 stocks of their choice, or be entirely out of the market altogether, and into real estate, bonds, or other asset classes if they feel like the market is getting too rich. The Peter Lynch argument for picking individual stocks is simple. If you invest your money into an index fund, historically you'll probably average a 6 to 10% annual return. However, let's say hypothetically that you invest $1,000 into 6 different stocks. 5 out of the 6 stocks go to zero and lose 100% of their value. But one of these stocks goes on to become a 10-bagger. Your return on your initial $6,000 investment is 66%, even though 5 out of the 6 stocks went to zero. There will always be that person that says, investing in individual stocks is gambling. Yeah, okay, says the guy that never takes a risk in his life and waits his entire life to retire. There's always a risk when you invest. However, with proper skill and dedication, anyone can improve their investing knowledge and capabilities. Risk and reward go hand in hand. But the earlier in life you learn to start managing risk, the more successful you will become. Now, before you invest in the market, there are some questions that you need to ask yourself. One being, do I have a place to live? Yes, we should all be investing, but not with money you might need to pay your rent. In addition, one may argue that paying rent instead of just buying a home is a waste of money. I personally was spending nearly $1,000 per month in rent, and just recently purchased a duplex. My monthly mortgage and escrow payments come out to be $1,500, and I collect $1,050 from the tenant per month, so I'm left to only cover $450. So in this circumstance, purchasing a duplex was actually the best financial move that I could make. But remember, with real estate, location is the most important thing. Another thing you need to ask yourself is, can you afford to lose this money? Or will you need this money for the next 2 to 3 years? If you might need this money in the short term, be cautious about investing it. Finally, the last question you want to ask yourself, and this sounds stupid, but do you have the temperament to invest? If you tend to overreact to little things such as a ref calling a foul on you in a bar league basketball game, you might tend to overreact to seeing your money drop 20, 30, sometimes 40% in a market pullback, and you never know when they're going to come. No one can predict the market. You can say, well, historically the bull market lasts about 8 years. Interest rates are rising. The yield curve is inverting. There's a head and shoulder pattern. Kanye West is running for president, and kids are eating Tide Pods for dessert. This is the market top. The simple fact of the matter is, there are over 60,000 economists in the United States trying to forecast recessions and interest rates. If they could do it successfully twice in a row, they'd all be millionaires by now. Focus less on timing the market and instead focus on what you know. Look at the companies and industries that you're familiar with. You have an edge being the consumer sometimes. You can spot trends far before the Wall Street analysts. I personally made a bet on Facebook stock when analysts were worrying if the company could profit from smartphone users versus desktop users. The company also acquired an app called Instagram at that time, and I knew how popular Instagram was. Another bet I made was investing in a company called Exact Sciences, a company that made fecal tests for colon cancer. I had heard about the company and then saw physicians at work writing orders for the test shortly after it had been approved by the FDA. Use your senses and identify companies. If you're looking at a restaurant stock and you drive past this restaurant every day and nobody's there, why would you invest in it? Also, you have to understand a company's size, as smaller companies are likely to have huge value swings versus large, steady companies. There are 6 classes of stocks. There's the slow growers. These are big established firms. They're at a stage where they'll rise only slightly quicker than the overall economy. They usually grow at a rate of about 5 to 7% per year. A good example of a slow grower would be PepsiCo or Procter & Gamble. Next, we have the stalwarts. These are established firms. They're relatively dynamic, but they're not as agile. They might grow at a rate of 10 to 15% per year. Starbucks is a good example here. Next, we have the fast growers. They grow fast, but they can also pull back fast. A good example here would be Square. If you pick the right ones, your portfolio can really outperform the market. But if you pick the wrong ones, well, Ben & Jerry's, Netflix, and some booze might be your next step. Pick these stocks carefully. Next, we have the cyclicals. These companies have a natural swing in their stock performance. Airlines, automobiles, defense plays, tires, steel, all those things are cyclical in the economy. And to be honest with you, these stocks aren't always your best choice, especially in a hot economy. Next, we have asset plays. These are firms that might have valuable assets that you don't think Wall Street's pricing in. An example of this is Sears. A lot of people said that investing in Sears was good because they had some valuable assets. That turned out to be a nightmare. Finally, we have the turnarounds. These such companies can provide great opportunities, or they can be complete duds. This is what everyone's thinking GE could be right now, but time will tell. Now, once you identify a company, do your homework. Now, what kind of homework am I talking about? Basically, learn everything that you can about the company. What their balance sheet looks like, who their management team is, how they compare to similar companies, and so on. To make this a bit more quantitative, here are 5 signs to look for. The first one is a low price to earnings ratio. Now, people are going to jump on me, but this is literally what's in the book One Up on Wall Street. Now, when you're looking at the price to earnings ratio, compare it to similar companies with similar growth rates. It's just a simple valuation measure. Another thing you want to look at is a low percentage of institutional investors. Why? Because if there's a low percentage of institutional investors, that means that if the institutions start buying this stock, the price is going to be driven up really fast. You also want to look for insider buying in the company. If the CEO keeps buying back shares, usually he might know a thing or two about the trajectory of the company. Another great sign is the company buying back its own stock. And finally, look for a low debt to equity ratio, especially compared to similar companies. Now, even if you found a stock that looks really good according to the numbers, don't invest just because of the numbers. Make sure you can describe why this business is good and why you're buying this stock. Stating that the stock is going up and that's the reason you're buying it, it's not a good reason. And also looking at analysts and saying, well, 9 out of 10 analysts say it's a buy, that's also not a good reason. You need to be able to point out why you're buying the stock. Is it in a good industry? Where do you see that industry heading in the next 10 years? My favorite tip, the second you see people on CNBC announcing that an industry or a specific stock is hot, you should start seriously thinking about selling that stock. Lynch all but says, do the exact opposite of what analysts are saying, particularly in the media. The hot stocks are a bad idea, but the boring stocks, they're usually a good idea. When you identify a winning stock, remember, don't put your eggs all in one basket. Diversify your portfolio amongst 6 to 10 high-quality positions. Next, be patient. As long as the fundamental reasons for investing in that company didn't change, don't get impatient. Sit on that stock. Sometimes it takes years for a stock to truly take off. And when do you sell a stock? Well, don't just sell a stock to take gains. If your reason for owning that company is still true, you're probably guaranteeing that you're going to miss out on additional gains. Along the same lines, you should know exactly why you own a stock. If you own a stock because the CEO is a visionary and has led the company for years, perhaps you would consider selling if the CEO steps down. Another great rule is to use market-wide sell-offs to buy more shares. This just means that the market decided to put stocks on sale for you. Take advantage of that sale. High-quality companies will bounce back. Another rule, don't just buy a company because you believe it's a value. If it's trading at a low PE and has been trending down for years, there's probably something wrong there. Don't just blindly look at the PE ratio and think a stock's cheap, because stocks follow earnings. And if their earnings were going up, the stock price would be appreciating as well. Finally, in the entire book, if you get one thing out of this book, remember this. If you can't convince yourself, when I'm down 25%, I'm a buyer, and banish forever the fatal thought of, when I'm down 25%, I'm a seller, then you'll never make a decent profit in stocks. In other words, don't invest in a company unless you have a compelling reason to invest, and believe in that reason. I know this all seems like a lot. There is a lot of content in this video, but the main takeaway for this video should be to use common sense with investing. Do you think technology is going to outperform the market for the next decade? Or do you think industrial stocks are? Use common sense. Look at what's going on around you. And when you finally make a decision to buy something, have the patience to sit on those shares. Thank you for watching this video. I hope this summary of One Up on Wall Street helped. And please hit that subscribe button.